Hey friends, in the video today, I have a free framework that I want to share with all of you that is critical to my own dividend stock investing. This framework is helping me right now identify the exact types of dividend stocks that I want to buy right now in 2024. We all face different journeys in dividend investing, and as we go through different chapters, different stages of the journey, the types of stocks and ETFs that we all buy might differ by chapter of that journey. I'm really trying to understand right now in 2024, what stocks and ETFs, closed-end funds, other vehicles should I be purchasing for myself right now? And this framework has helped me so much. Check it out on the screen right now. You're going to see with this framework that the way it works is the investor needs to ask themselves 6 different questions. There's 6 different questions in this framework, and the answers to each question range from a 1 through a 9. So you just rank it 1 to 9 on each question. And so the first question is about timeline. And really what the investor needs to do in this first one is understand, hey, there's a lot of time until retirement. And if there is a lot of time until retirement, the investor ranks a low number. On the other side of the chart, all the way on the right, there's not much time until retirement. There's little time until retirement. In this case, the investor will put a higher number. I ranked myself a 9 on question 1. I have little time until retirement. Sure, if you just look at me in the video today, right now, you could say, hey, Ian, you have a long way to go. You have a lot of years until retirement. But the way I'm answering this question for myself is how many years, how closely am I to retirement right now in my dream state? Yes, I'm a bit younger. I don't really have to retire right now, but I want to retire. I want to enjoy financial independence, retire early. And even if I have all of that cash flow coming in that covers all my living expenses, sure, I'll still keep working, but I'm really defining retirement here in this first question as having all of my cash flow cover all of my bills. And so for me, I want to have that retirement dream much sooner. And so that's why I ranked myself a number 9. Now, important notes on this one. There may be someone out there who ranks themselves all the way on the different end of this scale. They might put a 1, but it's really important to realize, hey, even if you want to work a lot more years, maybe there won't be so many years of work ahead. Maybe if you're in a field, for example, that prioritizes and rewards younger workers and you're getting a bit older, even if you want to work many more years, is it realistic? Are you in an industry that will allow for that many more years of work? Also, worth noting, I have a philosophy. I think it's not only about number of years that someone has worked, but I like to look at how hard have those years been. I've had a lot of hard years of work, and I believe in our lifetimes we have so many hours of work, hard work that we can really do. And so I'm kind of in this bucket as well that, hey, I'm younger, I'm in my 40s, but I'm approaching this goal of financial independence, retire early. I want to approach it sooner than later because I've had a lot of hard years. I've probably worked as many hours as some of the older people watching the channel right now. And it's because I put in a lot of hard years where I was working till like 3 a.m. at night, every night of the week. And it was rough and it was taxing on me. Anyway, on the first question, I put a 9. Follow along at home. Try to answer these, if you will, on paper at home, because we can share in the comments below and kind of discuss as a community where we all line up as investors. But let's go on to the second question. And so as you can see on the screen in front of you right now, the second question is about stress level. If you as an investor are facing a really low stress level, you would put a low number here. If you're facing a higher stress level, and I'm talking about stress just in life, and what is at the epicenter of stress? Usually for a lot of people, it's kind of job, it's like work-related stress, but this stress could be just anything. If you have a higher level of stress, you put a higher number here. For me, these days, stress has actually been a little bit higher, so I put myself at an 8. And part of that stress is realizing at this point in my life, hey, I just need the cash flow to cover the bills because I need that weight off of my shoulders. And it's kind of the stresses of life, the stresses of active income, they're kind of getting to me. And so obviously the theory here is that seeing passive income, seeing a lot of passive income kind of coming through, higher dividend yields, higher yielding stocks, it can reduce stress. It can be a stress reducer to have more passive income, higher yield coming through. And so let's go on to the third question. This one is about risk tolerance. All the way on the left-hand side of the screen, it's lower risk tolerance. So someone with a lower risk tolerance would put a low number, 1 through, say, 5. On the right-hand side of the screen, higher risk tolerance. Someone with a higher risk tolerance could put maybe a 6, 7, 8, even maybe a 9. For me, I put a 4. I put a 4 on this particular question because whereas I'm getting closer to FIRE, whereas my stress levels are high, I cannot stomach even more stress in having a highly volatile portfolio. I cannot stomach a situation where the portfolio is fluctuating massively or even where I face permanent losses of capital. And so for me, I'm going after a lower portfolio volatility. And so I placed myself at a 4. And typically what I found when I'm analyzing quality dividend stocks, those that have lower yields, say between 2% and 4%, typically those are going to be less risky investments, lower volatility investments. I'll give you a great example. One of my favorite stocks of all time, Johnson & Johnson. It's kind of yielding right around, say, typically between the high 2s and low 3s. That one is a lower kind of volatility, a less risky stock, if you will, than some of the sin stocks I own, like Altria. Altria yields a lot more, but with that higher yield can come more risk. And so when I'm balancing my portfolio, when I'm deploying capital, I'm trying to keep all of these in mind. So in the video today, you're going to see at the end my total score, but I'm trying to analyze my strategy from a variety of viewpoints. But let's keep going. As you can see on the screen in front of you right now, the next question, I want to go through portfolio size. And so a larger portfolio by dollar value, it's actually going to have a lower number on the scale. You'll see why later. You'll see why. You'll see how this works. A smaller portfolio by dollar value is going to have a higher score. And so I gave myself a 4. My portfolio, in the scheme of things, it's actually a larger portfolio. It's a larger portfolio. And the theory here is larger portfolios by value, they can kind of afford to skew towards lower yielding lower yielders in retirement, lower yielding investments, because when you have more capital that you're working with, you don't always have to go after the high yielding stocks. When you have a larger portfolio, you have the luxury of going after those lower volatility, lower yielding stocks that are ultra high quality companies like Johnson & Johnson. And so there are benefits here to having a bigger portfolio, that is for sure. But if someone by contrast has a smaller portfolio, that investor is going to have to work with what they have a lot more. They're going to have to make that portfolio do more for them. They're going to have to get more of that out of that portfolio if they want to retire in the near future. They're going to have to get more yield out of the smaller portfolio. And so on this particular question, I would say I'm fortunate in that my portfolio in aggregate skews bigger. And so that's why I gave myself a 4 on this question. But let's keep going. As you can see on the screen in front of you right now, the next question, which is number 5, is just cost of living. Do you have low overhead? That would give a lower score, like a 1, 2, or 3. Or do you have a high overhead, a higher cost of living? That would give a higher score. I gave myself a 9 here, so I have a higher overhead. And I've always talked about that. Fat FIRE, fat financial independence, retire early, having higher costs. But let's be honest, living expenses have skyrocketed. Honestly, overhead is higher for all of us. So even if you think you're frugal, even if you're view yourself as a low overhead person, just keep in mind that you may want to score yourself higher on this than you otherwise would because of inflation. And unfortunately, the higher the overhead, the higher amount of passive income must be generated. And of course, that's never fun. But I place myself as a 9 here because I know my overhead is high and I'm going to have to cover it. And so I want to round out the questions today with one more, and then I can summarize them. And you'll see why the summary of all of this is so illuminating. It is so helpful to understand where someone should go, generally speaking, as a dividend investor. And so the next one, as you can see on the screen, the last question, number 6, comes down to just account structure. Do you have your money in a taxable account structure, or do you have your money in a retirement account structure, or is it somewhere in the middle? A taxable account structure is represented by lower numbers. A retirement account structure is represented by higher numbers. Often, obviously, retirement accounts are really advantageous for higher yielders because they shelter the impact of taxes. And on certain high yielders like real estate investment trusts, closed-end funds, those types of investments come with higher tax consequences if they're held in taxable accounts, but in retirement accounts, not so much. Unfortunately, I rank myself here as a 3. I have a blend of taxable accounts and retirement accounts, but I skew very heavily on the taxable account side, and there's benefits to that as well. I can tap into those dividends right away with no penalty consequences. There's no early penalty of taking money out of the retirement accounts. And so there are good things here to having a lower number as well. But I'm a 3. I'm a 3 because I skew towards a taxable account structure. So here's the deal. Here's what's fun about this framework. You all know my portfolio. I did a review recently. I'll link to it in the pinned comment below. I did a portfolio review. Now, my patrons, I'm going to link to this in the pinned comment below as well. The corner patrons, that tier of Patreon, I share my portfolio, the percentage allocation to each position in the portfolio, all 37 positions. I did a portfolio review. I'm coming in right now about 3.76% portfolio-wide yield. When I did that portfolio update, again, I'll link in the pinned comment, my gut told me, Ian, that is too low of a yield for where you're at. And I looked at my dividend growth. It seemed a little lower than where I should be too. But what I was more concerned about is the money I have deployed. I'm not getting as much leverage out of that money right now as I should be for where I'm at in my life stage right now, my life right now, personally speaking. But what did this framework, what did this exercise today tell me? Something that very much validated my gut, what my gut reaction to that portfolio review. So as you can see on the screen at the bottom, what I do is I add up the score and then I average it out. And I didn't tell you this at the beginning of the exercise because I didn't really want to skew your answers, but each of the numbers here, it really represents a kind of percent yield, if you will, a dividend percentage yield. So I have 9 plus 8 plus 4 plus 4 plus 9 plus 3. Those are the 6 answers. I sum them up, and then I get an average by dividing by 6 because there were 6 questions. I rank each question equally. Of course, there's other questions I could have asked today. Feel free at home to take my framework and make it yours. Ask questions that you think I should have asked, but I left out. But anyway, this was simple for me for today, and I average out at a 6.16%. Again, the numbers today, the 1 through 9 or 1 through 10 actually is what it could have been. My highest score was a 9. They represent percentage yields. I didn't say that at the beginning because, again, I didn't want to skew your answers. But I'm coming out at a 6.16. What this tells me, Ian, right now your portfolio is at a 3.76, but you ought to really be, based on the answers, and this is directional, at a 6.16. What this framework told me today is I'm undershooting on yield. I'm undershooting based on where I need to be for my life right now. You may fill this framework out at home and come up with something completely different. You may be looking at having a yield in the 1, 2, or 3% range. This is meant to be personalized. This is not investment advice. I'm just sharing my journey, my very, very personal journey, which may only make sense for me and no one else. But what this tells me is I'm yielding portfolio-wide too little now as compared to probably where I should be. When I did my portfolio update, I thought, hey, I want to kind of get into the mid 4s. And what it's telling me today is probably more in the 6s. Now, what I'm focused on in deploying net new capital is not getting me to where I need to be. And that's the next part of the video. So I want to share that. So look on the screen right now. Check it out. I have an Excel spreadsheet here. And what I want to share in the spreadsheet is, as you see at the top, it has my goal. It kind of has where I'm at. And that goal, is it really portfolio wide or is it net new capital? This is meant to be directional. There's no real answer to that. I'm not selling anything. I'm not doing that, at least at this point. Just on net new capital, I want to get closer to, say, 6%, a lot closer than I am. But let's look at it. This week, what am I going to do? I plan on buying SCHD. I've talked about this a lot. I'll link to it in the pinned comment below. Yield is 3.35%. What did I buy last week? My patrons already know this. I bought Chevron. Bought it at $143.74. And the yield is 4.54%. I bought Chevron because honestly, I felt like that's in the sweet spot of yield. That's where I really want my portfolio overall to get. Although the analysis today showed over 6%. But again, this is directional in nature. It's not a precise science, but it's telling me in my journey, Ian, you need to depart from your prior ways. You have to be more focused on bringing the yield up. And so as you can see on the screen, when I just do a simple average of the two, where do my trades get me from last week and the one I expect to make this week in SCHD? The blend is about a 3.94%, which is only slightly higher than my portfolio average, which is 3.76. That tells me, it helps me understand, hey, I need to course correct here. I'm probably not buying the right stocks for where I need to get. And so here's a possible alternate. I started playing around with some different options. Well, an alternate could be this. Ian, this week, you're buying SCHD. I already know that. I know it yields less than my portfolio average, but for strategic reasons, mainly the dividend growth and the diversification, I'm buying it and I'm bringing it up to a top 5 position. So to counterbalance that, why not add in next week, for example, a closed-end fund like FOF? Well, FOF pays monthly dividend distributions of 8.7 cents per month. And when I annualize those, the yield is about an 8.22%. Well, if I alternate between SCHD and FOF instead of SCHD and Chevron, the blend, the simple average of those two, is a 5.8%. I just take 3.35, I add 8.22, divide by 2, 5.8%. Hey, 5.8% is a lot closer to kind of this goal state of 6.16 than the 3.94% from the prior example. And so this is really how the framework works. It just helps me understand how I need to blend investments as I structure my portfolio from getting to point A to point B. My journey has evolved over the years. In my younger years, I was all about the dividend growth stocks because I was going for yield on cost. These days, I'm all about getting there, finishing the race, completing the race. Will I quit work? Will I stop working? No. Will a huge amount of stress be taken off of my shoulders? 100%. Absolutely. That's where I need to go right now. And so the framework helped me identify where I need to go. And then I can kind of drill down on the stocks and start playing with different scenarios. And I don't have to deploy money week to week in the same positions. But what I'm starting to realize, and I discussed this when I was buying BTI and SCHD earlier this year, a few months ago. I'll link to that video in the pinned comment below. I realized by blending different positions, I can get both of the dividend growth stocks and the higher yielders in there and boost portfolio yield. And so that's where I'm at right now. Let me know in the comments below what you think, what your score is, what your goals are right now. And if you don't mind, please go ahead and click the like button if you enjoyed the video today. It would mean the world to me. Before I go, in terms of a full disclosure, I own the stocks mentioned today. I own SCHD, that ETF, my favorite ETF. I own Johnson & Johnson, ticker J&J. I own Altria, ticker MO. And I own British American, ticker BTI. I own those stocks and that ETF in my personal dividend stock portfolio. I also own Chevron, ticker CVF. X. Before I go, in terms of a friendly disclaimer, today's video, it's not investment advice. I'm not a licensed investment advisor. Today's video, it's just for your fun and entertainment. If you're going to go out and invest in the stock market or anywhere else, please consult your licensed financial advisor first. It's possible to lose money in the stock market. I'm just sharing my journey and my framework today for fun and entertainment. And please always check out the description below for additional disclosures and disclaimers. I love you all. Thank you for watching the video, and I'll see you in the next dividend stock investing video.